Orchard Securities, we are a managing broker-dealer, so we're a securities broker-dealer that focuses on alternative investments, primarily real estate. We've done about $3.1 billion in equity over the last 15 years, representing close to $7 billion of total real estate transactions. We really cut our teeth on the 1031 space back in the TIC arena. I'm sure a lot of you have heard of that before. So we were doing the real estate, the securitized tenant and common deals. In 2002, those took off quite a bit. In 2004 is really when the DST world started taking shape. So I'm gonna dive through this. This is very brief. It's about 11 slides of information. I'm really just focused on giving you a historical perspective and kind of where we're at right now on these securitized DST transactions. Is there a way to scoot it up a little bit? It doesn't look like it's. Oh. It seems like it's. I'll go over the slide. You can't really see it, so it's not quite as meaningful for you. But on the left side, you'll see the graphs much higher. In 2006 was really the time which real estate was booming at that time. Most of that, about 95% of those deals were being done as tenant and common deals. $3.65 billion in equity were done in the securitized TIC arena. There was another about $1.5 billion done as real estate TICs that some of you may or may not have been involved with. Back then, really the TIC deals were primarily being done as multi-tenant office and multi-tenant retail. As we transition into this slide a little bit further, you'll kind of see we've moved a lot away from the moving part type of deals. These deals are not for investors that are looking for moving parts. And really the DST, if you get into the technicalities of the structure of a DST, are for single tenant deals, apartment deals, senior housing deals, things that you're not going to see the ebbs and flows as much in the real estate transaction. Where we're at today, we're at $1.2 billion raised in the first half of the year, so it looks like about $2.5 billion will be raised this year. We were just under $2 billion last year, so the growth that we've seen hasn't been as the exponential growth that we saw in the early 2000s, but definitely seeing some progress towards that and having a lot of success at moving it at a larger pace. This is, the last one is a graphical use of that. This one's going to be a little bit more of the numbers. So a couple things to point out on this slide. Currently we have 42 programs that have been subscribed the first half of the year. Last year were 95. Back in 2006 there were 341 programs that were being done. Big reason for that is tenant and common deals only allowed for 35 investors. These deals allow up to 499 investors. TIC deals, every investor had to be underwritten. So you had to have good credit, you had to be approved by the bank. Your closing packet was about that big, and up to 35 investors, you didn't see many deals that were larger than maybe $20 million, $25 million equity raises. Now we're seeing deals where they're pooling together 5 assets. You might have a $120 million equity raise in one deal. And if you have an investor that has $500,000, really easy for them to diversify into 2, 3, or 4 deals. Tenant and common deal, that didn't happen. The minimums were $350,000 to $600,000 all the time. So the DST structure for that, a lot easier to diversify, a lot easier to invest, and a pre-structured deal with a lot more realistic financing for that. Going on to the next slide. I'm sorry it's so difficult. Thank you so much for helping me on it. I don't know what I screwed up. I put it in PDF because I use Mac and it sometimes jumbles it, so maybe that's the challenge with that. Okay. You can flip through, actually, the next slide kind of just shows briefly, again, we're looking at probably $2.5 billion, maybe $2.7 billion this year, but you can go to the next slide. Okay, so these may or may not be companies you've ever heard of. Inland, you probably heard of. They've been around for a long time, 40 years, started as a few school teachers. They represent 30+% of the marketplace. People trust them. People have known them for a long time. They're really good at what they do. Keith Lampy, who was here presenting on that, is someone that's been around for a long time, and trust is a big part of this, right? I mean, these investors are looking for passive deals. The investor that wants to go in and roll up their sleeves and be involved with real estate, these are horrible for those guys. They'll hate this. These are illiquid investments. You're looking at a 7 to 10 year hold strategy typically. And so for the investor that said, hey, I'm past that, I'm past my principal appreciation stage, I'm looking for a down the middle of the road, low risk type of 5 to 6.5% cash flow type of play. That's where Inland, Pasco, these groups kind of focus on and have had a lot of success doing. So Inland last year raised about $620 million, if I remember correctly, in equity as one company. That's a big group. I mean, they're buying $1.5 billion worth of real estate to be able to structure that many deals. And it shows that the trust kind of scenarios where people are looking. You can see a lot of these other names. I can't think of any of these that are in the Pacific Northwest as far as companies. We have seen a few properties that have been done in the Pacific Northwest recently. There were 2 properties done. Actually, Bourne did a DST deal up in Kennewick in the Tri-City area. In Washington, there's another deal that was done in Richland, right close to that. That's an apartment deal that's just kind of finishing up by a group called Starboard that we're involved with as well. Going to the next slide. This will be pretty quick. Sorry, the salad looks delicious here.
The next one's a PowerPoint, so it'll be a little cleaner.
This is equity type, so apartments heavily favored in this space. Again, I think it's heavily favored in a lot of spaces right now. People are looking for good quality multifamily that they're able to kind of grow with. It's something that people always need somewhere to live. The TIC World did, in a future slide, you'll see a little bit of apartments, but now it's definitely one of the favorites. In the future slide, we'll show you kind of 2007 compared to today, and I think that's meaningful. We are seeing some outside of the main 4 food groups. Really haven't seen a lot of hospitality. That's kind of the pointy end of the stick. We are starting to see more energy that's being done. Some self-storage, those are tough to come by for the cash flow and the cap rates that are out there. A little bit of industrial, but primarily multifamily. The office and retail are not multi-tenant. These are very much maybe 1 or 2 tenants, long-term leases, 15 years left on a lease, 12 years left on a lease. No moving parts during the hold period. That's really what these investors are looking for. Skip 2 slides, if you will. The next one. Oh, yeah. Yeah, go to the one up. No, sorry, the next one. Up. The next one up. No, the other way. Down, up, sorry. Okay, who's on first? All right. 2007, I really like to slowly show this slide because it kind of shows the change of where we've been from. And I've talked to it a little bit, but office, multi-tenant office was the sweetheart. A group called TripleNet who morphed into Grubb & Ellis was doing a lot of multi-tenant office. And what we realized is on TIC deals with 35 perfect strangers, if Taylor, James, and I got together and tried to figure out where to go to lunch, we'd probably have a little bit of hard time, but we'd figure out where we're going to go. You get 35 perfect strangers together trying to figure out if they want to do a capital call because a tenant just went dark in a multi-tenant office across the country, and you have a farmer and a banker and a dentist all together trying to figure it out, plus 32 of their closest friends. Really, really, really hard to make decisions. And it has to be a unanimous decision. Tenant in common, really, really difficult in that scenario. Everyone realized it after the fact. And really, it's not the industry's fault. It's the IRS came in and said, hey, we want to swing from the limited partnerships where the general partner has all the say because of that mess of the 70s and 80s and trying to clean that up. So now the investors have all the say. And it was a bad deal. The office deals and the multi-tenant retail deals and tenants going dark really affected the decision-making power and the ability to do what needed to be done, which is some capital calls and accepting certain tenants and paying those tenant improvement and leasing commissions that came out of it. Today we've swung much more to the lower risk-adjusted return type profile, a lot of single-tenant deals, a lot of apartment deals, Class A apartments in pretty major markets that we're seeing. Arizona as an example, Florida, a lot of growth states is typically what we're seeing. The senior housing has been a really responsive 1031 type of product, but it's been difficult to get financing just because it's more of a local market. So if anyone here has great financing relationships, we'd all love to know about it because 1031s with DSTs, getting that local market is something very meaningful and could be an opportunity for anyone here if you have it, especially with Bourne and some of the products that they have that could go into these products. To the next slide, it's kind of where we're at in the marketplace snapshot as of the end of the second quarter. Raised $1.2 billion in equity. Here are the stats. Industrial's 2% of the marketplace, 238 days on market to raise the equity. Average yield was 4.3. That was an all-cash deal. It's kind of unique. It's really not a great representation of the interest level in industrial. Multifamily, 54% loan to value. So these are pretty low loan to values, relatively speaking, from a real estate perspective. Again, trying to take the risk profile down a little bit for investors. They're trying to play for the downside risk and being able to work through a change in market conditions that maybe 10 years ago, TIC deals were more of the higher leverage, 65, 70% all-in loan to value. Average day on market, 84 days. These deals move quickly. Again, Inland had a $120 million equity raise that took, I think, like 100 days. That moves the needle pretty quickly for this. Office, these are single tenant deals. There's one office building that's been on the market a long time that kind of skews that a little bit. And the 43 versus 58% is because of all cash deals versus typical loan to value deals. Senior housing, this deal was born. So it took 113 days to raise 18.8 million of equity, and that was up in the Kennewick marketplace. All right, so last two slides. We're about 1.35 billion after July. So I wasn't able to update this because we didn't get the numbers till this afternoon. We had to get it approved earlier. So we have 25 sponsors. So something unique about the TIC Arena, there were 85 sponsors. It may not mean anything to you, but there are 85 different groups that were trying to raise money. It's pretty easy to get in. If you could fog and mirror, you could get the financing for it and get the mezzanine finance in place to be able to bring these deals out. It's a lot harder now. A lot more barriers to entry. Being able to get the mezzanine financing, which is the money you need to take place of the equity while you're raising the capital for the deal, a lot harder to get. TIC deal, you had an underlying real estate. A mezz lender could take the property back if they wanted to. You can't do that on a DST. A DST is structured with very few moving parts and don't have the ability for a mezz guy to be able to go after it. So that's probably the biggest barrier to entry that we see. Because of that, we only have 30 active sponsors in the space, so much fewer, much bigger amount for those top 5 sponsors and how much equity that they're doing. Available offerings, we have 78 so far. 2017 was 126, so we'll do more of those. You guys probably 506B versus 506C is talked to Mr. Zink back here, working on maybe a 506C version of these offerings. 506B means you can't generally solicit. Probably doesn't matter to this group though. 506C does allow that. Mostly done as DST deals, and average loan to value is really in the low 50s. I kind of want to bring this back to why is this interesting at all to you guys? And these are done as securities transactions, so need to be licensed to be able to get paid on them. How a lot of real estate agents we're seeing are using these are basically to get the listing. If you have a group that's concerned, they don't want to go sell their fourplex or their 40-unit apartment complex and buy another 40-unit apartment complex down the street because you're trading the exact same risk profile. 1031s are challenging because, hey, I'm selling at a really good price. I have a lot of gains, but guess what? You're investing in that exact same marketplace. So there's not a big change in what you're doing unless you're going to go get a value add deal and you're getting out of a stabilized asset. DSTs allow for a variety of things. They allow for a fully structured product where the financing is already in place. I think all of us have been involved in real estate transactions where you're getting ready to buy something and you pull the curtain back and some bugs run out or the financing doesn't come in place or the appraisal doesn't come in where it needs to be able to close on that deal. And if someone's past their 45 days, that can be a real concern. These financing's in place, fully structured. This is a full private placement memorandum that's written by national law firms. So you can go into these deals knowing everything that's involved with that product before you get in your 45 days. If you get someone in their 35th day, sometimes it's really hard to come up with some viable options for them. So this is something for that, and obviously Taylor does a lot of that. I think that diversification from both a geographic and an asset type perspective is something else. If you had someone that had a $5 million exchange and they put $4.5 million in something, this is a great place to be able to put another $500,000 to be able to diversify their portfolio. If they're buying something in Portland, they can get something in Arizona or get something in Oregon or get something in Texas or Florida, the Carolinas, where a lot of stuff's getting done. And so utilize it. Think of it as a tool in your, an arrow in your quiver to be able to work with your 1031 investors. And again, make sure it's the right investor. You don't want to have someone that wants to roll up their sleeves, get really involved with real estate. Hey, I want to go look at the property today and I want to go look at it again next month. This is for someone that's past that. They're getting more in their retirement years, want to go play golf or hang out with their grandkids and be able to get more of a passive income on something that's more institutional. And they're not the single owner. They're part of maybe 50 or 100 other investors that are buying a big park and looking for that diversification play for them. So
Taylor, one question I get a lot is how safe is the DST? And I always explain what's real estate, but it gives me a chance to then discuss the due diligence process. So can you maybe touch on that, what a DST goes through from the time a sponsor company finds a property to purchase to when I can share it with a potential DST client?
Yeah, securitized deal is not a caveat emptor deal. A lot of oversight goes into our space, and there are 5 groups that are going to look at every one of these deals before an investor gets the chance to look at it. We have the legal counsel writing the PPM, the sponsors obviously doing their due diligence. You have a third-party due diligence group that is obviously a third party to the sponsor. They're not getting paid by approving the deal. They're looking at the deal and making a decision if that's something that they like or don't like, and they'll give you the pros and the cons to every one of the deals. You have the managing broker-dealer, which is us. We're going to help structure that deal and make sure it's a clean deal. And you have the retail broker-dealer that's going to be looking at that as well. Every single one of us has a duty to make sure that everything is disclosed. Every risk that can be conceived in a property is in the risk section of the PPM. You're going to know exactly what's going on at this property. You're going to have past performance. If it's a single tenant, you're going to know who the tenant is and have their financials. They're typically a publicly traded company. If they're a private company, you're going to get access to the financials. So there's a lot to these deals that make sure that these are what they say they are, and no one can pull something over on you. And there's a lot of really sharp groups. Our CFA has looked at thousands of deals and is looking at more of them every day and making sure that they're everything appropriately is disclosed there. So does that answer kind of what you're asking?
Thank you.
Yeah.
So I'll have James come up next with Warren Financial Group to talk now more about senior housing as an asset class. In all my times here at CCIM, I don't remember many, if any, conversations about senior housing as something that somebody had as to list or looking to buy. So we thought this would be a good topic to delve into and bring more insight here into CCIM. So James?
Perfect. Thank you. Well, it's good to be here. I travel all over the U.S. You'll hear a little bit of an accent. I'm not originally from Florida. No one is, right? It's kind of like Phoenix. I'm originally from Tennessee. James Ray, middle name's not Earl. Let me clarify that right out of the gate. I've been on your side of the fence for almost 17 years, not strictly in the senior housing space. I started out in the restaurant space, working for the largest listed restaurant REIT in the nation called Trust Street. That got bought out by a little company called GE Franchise Finance, based up in Bellevue, and they had an office in Scottsdale, Arizona. And I humbly share I was their lead dispositions agent, not doing 1031 exchanges through DSTs or TICs, but directly through brokers like yourself nationwide that had a need for a net lease, the bond of the real estate world, if you will, investment property for someone who's coming out of something very management intensive and they reached that juncture in life where they wanted to basically take a cruise, go see the grandkids, and know that the rent was going to come, not guaranteed, but of course on a consistent basis. And a branded concept would be behind it. I spent most of those 17 years with a brief period of time where GE bought out one of the divisions, going from restaurant to, and this was prior to 2007, the height of the market, going from the largest restaurant REIT in the nation, working on the real estate side of the fence, to working with the third largest senior housing fund in the nation. At the time when we started that fund, the company I was working for, no one knew what assisted living was. It wasn't in vogue during that time frame. It started in '98, and it was sold in 2006, and then worked for the second largest hotel REIT in the nation. Also worked for the largest, what we call lifestyle or outdoor activity fund in the nation. They had several properties, ski resorts, golf courses, marinas, largest owner of ski resorts, even bigger than Vail at one point in time, and then moved over to a healthcare fund. So I've been across multiple sectors of real estate, both on the real estate side of the fence as well as the securitized side of the fence. And you know, the folks that are up here work on that side of the paper side of the business, if you will. And you know, as I sit up in front of, or stand in front of you guys here today, I would share with you one of the business ideas I would give you is I would highly encourage, whatever your expertise is, whether it's industrial or multifamily, pay very close attention to those public earning calls, because there's a great Green Street Advisor report that came out about 2 weeks ago that said that the NAV values for publicly traded REITs by sector are 96% correct for 12 months later for the real values of the real estate. So the public markets, the securitized markets, are the precursor to where the direct markets go to. So I'll launch into that. The fund I work for, Bourne Financial Group, was started by the gentleman who started the company I worked for before, C&L. I used to work for a company called C&L. Bob Bourne was the co-founder of that company. This is a little bit of his background. He's been in the business of real estate going back to 1973, the year I was born. 45 years in the business, through 6 recessions. He has, you know, acquired over $30 billion worth of real estate, and $6 billion of that was in the healthcare space. He left that company, and shortly after I left as well, went to work for him, and he started Bourne Financial Group, which out of all the sectors of real estate he could have invested in, he had an even broader band of experience. I think the only sector he didn't invest in was self-storage. He said, you know, what do I want to do with the rest of my life and with our family money? I still want to work. He felt the best risk-adjusted returns was in the senior housing space going forward. And I'll show you a slide later on that, as of recent, the smart money agrees, at least on the securitized side of the fence. So with that, I mean, he basically assembled 4 different funds. And if you look at the map, a lot of them are actually up here in the Pacific Northwest, all focused on private pay senior housing. I'm going to underscore the word private pay. Not that there's anything wrong with government subsidized senior housing, because in a lot of cases, the government subsidized beds pay more. But from an investor standpoint, you want to remove some of that volatility, the ability to change regulation and therefore change the revenue, and that has an impact on the rent, of course, and therefore the value of the asset. So he's acquired over $500 million worth of assets, raised over $100 million worth of capital through financial advisors and investors here in this community. And many of those investors, by the way, invest with you on a direct real estate side. So if they believe in it directly in a property they own, it makes sense that they would believe in it indirectly through securities, whether it's REITs, whether it's private placements, or whether it's DSTs, right? And in our fund in particular, I'll just briefly touch on this before, and again, I'm not here today to give anyone investment advice. I'm here to share with you our vantage point of where we see trends in senior housing, where it is today, where it's going, and why we're excited about the space, and why we see the smart money, the institutions, the REITs, and even the lenders are excited about the space on a go-forward basis. The offering that we have specifically right now that's open to accredited investors only, it's a Reg D offering, minimum investment's $25,000. We're in the process of raising about $50 million, and we're going to buy, we've already got 3 properties identified that are private pay development senior housing. We'll probably end up building, so we're in the business of developing, leasing up, and then selling. There's 3 legs to the stool, right? And that whole process takes about 4 years. It's a year and a half to build, year and a half to lease up, and about 6 months to a year to sell. That, where we could interact with you would be on the acquisition side. If there's projects where you think it might be suitable for an assisted living facility, we would be interested to hear about those parcels, right? On the disposition side, a lot of our transactions go through brokers who are qualified in that space to represent those properties and bring qualified buyers. So, there is a, kind of a cross benefit here for both sides of the fence. But at the end of the day, what we're looking to do is in this fund, raise about $50 million, acquire, with leverage somewhere between $250, $260 million. That represents about 4 to 6 properties, and we're going to buy 2 of them. One of them is in, or 3 of them. One of them is in Port Orange, just south of Daytona, and then we've got one in Silverdale, Washington, and one in Spokane, Washington. And we'll add probably, as I said earlier, at least 1 to 3 more. So that's a little bit about the fund. Let me talk about the business very briefly of senior housing. As it pertains to the heartstrings and the purse string side of the business, I can't think of any other investment, especially in real estate, where you have that component, right? I mean, look, no offense to apartments or no offense to industrial or even retail, I can't think of any other sector of real estate that invokes emotion. When we're talking to investors, when we're talking to financial advisors, inevitably they ask the question, oh, how much leverage is in your fund? What's the return? But about the third question in is, hey, I'm dealing with this right now with my family. I got a mother or father I'm having to put into a facility. And for us, that's both exciting, but it also tugs on your heartstrings. So if one of the factors we look at, there's a great report done every single year by Genworth 2017 Cost of Care Survey. Our business, I don't mean to oversimplify it, it's a very simple business. We have 3 options, right? Or I call it 3 resorts. The Genworth Cost of Care Survey comes out every year in June. It shows the price of the 3 resorts by zip code. So you can pick any middle or major market in the U.S., and it basically says on the left-hand side over here, this is the first resort. Let's let mom stay home. It's probably more affordable. The house is paid for. We can hire somebody to come in. The last resort is no one wants to be the family member that sent mom to the nursing home, right? It's the most expensive. It's the least desirable. A lot of people would consider the resort, but they think it is priced like a resort, right? It's the most expensive. And when you look at the data nationwide, it's not the most expensive. Now, I do want to point out, these numbers up here don't represent the Pacific Northwest. They're a national average. Of course, they're lower in the cornfield of Iowa, but, they're higher here in Southern California. But these represent, roughly, middle of the road numbers. The bottom line is assisted living, senior housing is about $45,000 a year, and that's all in. That's food, that's housing, that's care that's delivered. And so it is the more affordable option compared to staying at home. People forget, even though the house is paid for, you still have to pay maintenance, tax, insurance. And by the way, I'll point out in the next slide, we're a big believer, everybody says it's location, location, location. We think the driver of real estate value is the jobs. And if you look at the fastest growing job categories in the U.S., and I think I breezed by the slide here, bear with me. It's, where is the slide? There it is, right there. You can barely see it, but according to Bureau of Labor Statistics data, the number 1 fastest growing job in the U.S. is healthcare. Right behind that is construction. A lot of that's from housing. So in this particular fund, we cover 2 Maslow hierarchy of basic needs, right? Healthcare and housing. And I point that out because a Wall Street Journal article said the number 1 fastest growing job inside of healthcare is home healthcare aides. It's also the lowest paid and has the highest attrition. So the lady that was supposed to take care of your mom calls in sick because her car broke down, or something happened, and at the end of the day, now you have your sister calling saying, hey, who's going to take care of mom today? So we need to figure that out, and by the way, we need to meet this Saturday and talk about the resort. So usually senior housing is not the first resort, it's the resort, right? It's the one you go to after mom stays home for a little while. With regards to the level of care, obviously there is a real estate component, whether it's senior apartments, and if you notice on the left-hand side of the graph, that represents the acuity of care. There's no care component to adult apartment communities. Then you get into independent living. Independent living usually requires an upfront lump sum payment. That has a level of economic sensitivity because if you can't sell your house, you can't come up with a payment to move in typically. We focus in our fund on private pay assisted living and memory care facilities where there's not an upfront payment. It's apartments for grown adults, so to speak, with a delivery of care component inside of it. We don't focus on nursing home beds or skilled nursing beds typically because that brings in the government subsidy. So we're kind of right in the middle, and you can see the monthly cost for, on a national basis, about $4,300 to $5,900. So about, $45 to $6,000. I'll transition through here real quickly and show you. For me, this is one of the things I think is the most appealing with regards to an investment focus into senior housing. A little bit of a busy graph, but I drew these amber bars here represent data from Real Capital Analytics. Any deal that closed $5 million and up across all major food groups of real estate from 2001 through 2017. And if you notice the roller coaster ride, we all know it, up, down, and up again, and a little bit of a pullback as of recent, right? It's pretty consistent, as I said earlier. It's jobs, 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 because if you look at non-farm employment, that orange line, it's the same roller coaster, up, down, and up again. The sector we invest in, and the reason we get excited, is look at this blue line. It's going straight up, right? Because the blue graphic below that is the aging demographic. Notice it did not dip in 2009. Notice it keeps going straight up. And also notice that it's not keeping up with the aging demographic. So if you got a lot of people and you don't have enough people to take care of them, what do you think happens to the cost of that service over time for those who can afford? That is the big objection, right? Are there enough who can afford it? I'll get to that in just a moment, but I want to point this out. For us, this is the most compelling thing. Everyone else looks at senior housing in the top graph. The 75, 85 plus cohort, if you look at really in assisted living facilities, the average age is 84 years. The utilizer of that facility, right? So if you look at the bottom graph, these are Census Bureau data takings going back to the 1900s and projected. You're going to see the biggest jump in the 85 plus age group between 2020 and 2030 that U.S. history has ever seen. 62% growth during that decade alone. That's what we're investing in. And by the way, beyond the end of our fund in 2021, which we have to sell at that time frame, there's another 23 years more of growth going out. And it doesn't pull back, by the way. If you notice, it kind of plateaus out through 2044. So we're very encouraged about the space, the long-term viability, and we're not discouraged about overdevelopment, both availability, overdevelopment, because we need to be building about 96,000 units a year, and we're only building about 25. If you looked at any of the data, it says occupancy rates are down right now. That's because a lot of the facilities that are out there are existing facilities. Their average age nationwide of about 17 years. We're building new facilities that compete with the older facilities. And so what do you think happens when you're the new kid in town and everybody wants to flock to that property? So we're excited about entering into a space where the vast majority of the inventory nationwide needs a rehab, needs capital improvement, and we're bringing a new property to the table. The big question is who can afford this stuff, right? At the end of the day, are there enough of those people to sustain your business model? I shared with you the slide earlier that says the average cost nationally is about $45,000. If you look at the age group, 75 plus that make $45,000 or more a year, there's almost 3.6 million people nationally that make that kind of money. And there's only 620,000 assisted living units nationwide. That's why we need to build more, because there's a 6-to-1 imbalance, and 1 in 6 retirees is a millionaire. Over the next several years, going out for 50 years on an annual basis, there's going to be $1 trillion worth of wealth transfer. So we're not concerned about there being a short supply of money, especially for a space where we require private pay versus government subsidy. We think there's room for both, and there's a need for both, right? But at the end of the day, it's a really exciting space for us to be investing in. I'll finish out with 3 more slides. Very simply put, the past of senior housing and going to the present looks really, really strong. This is a NACREIF chart that shows annualized total returns by major food groups. For 10-year, 5-year, 3-year, senior housing has been number 1. No big surprise. And only as of recent has industrial just slightly clipped it out, We're still number 2 on the 1-year total return basis. I love this graph. It's a little busy here, but the gray line in the middle going top represents positive rent growth, and anything below that gray line represents negative year-over-year rent growth. There's only one sector of real estate that's had positive rent growth going back through the Great Recession to 2005, and that is the flattest line, the flattest pancake on that chart, senior housing. At the end of the day, because of those reasons and because it is demographic driven, it's needs based, a lot of the folks in the securitized world believe it to be defensive. And if you think about the mindset of investors today, they look at their savings accounts and they're thinking, hey, good news is I'm looking good. Bad news is what's going to happen next, right? I need a place to protect my money. I'm on defense. I need a safety harbor. So a lot of investors are looking to this space, both retail investors, both institutional investors, and also lenders as well. Lenders are extremely excited about this space. I'd say jobs drive real estate. I'd say debt drives dirt as well, as many of you know. A lot of your investors need that spread in between, so the lending component is extremely important, and that's why one of the final reasons we're excited about the space. The smart money agrees. There's a great report. If you haven't downloaded it, you probably want to check it out. Emerging Trends in Real Estate, PwC and ULI. And it talked about the left-hand stack there is investment prospects and the right-hand stack is development prospects. Where's a great place to be in 2018 and going forward? Top place, no big surprise, fulfillment centers and warehouse, and right below that is senior housing. Bottom space, no big surprise, the regional malls and the shopping centers. So, by the way, to clarify, just bought a good amount of shopping center stock because I've got a little more time left to wait for that to recover. I don't believe Amazon has had the impact that everybody thinks it does, but in any event, hopefully I shared something with you that resonated. If anything you could take away from this is look for something to set yourself apart in your business. Something to create relevancy. We're excited about this particular space, especially as we interact with financial advisors, because we believe this particular space, at least on the securitized real estate side, is one of the most relevant and resonant investments that's out there today. So thank you very much. I appreciate it. Any questions or?
Yeah. So James, you have in front of you a large group of eyes and ears throughout the Northwest with access to land, dirt, properties. With Bourne being a buyer of property to develop, what would you look for? I think you're here just in time. Earlier in the marketing meeting, there was a sort of a investors with cash looking for property to buy. So if you made a pitch, hey, I'm looking for this, you've got a lot of people here who could probably source something that might be of interest for you. So what were some details you would look for?
Right. So from a demographic perspective, we're looking for, obviously aging population growth that's above the state average with high household income because we are private pay focused. We're also looking for another demographic group of 35 to 45 because usually the parents want to be near the kids and vice versa, but not too close, right? And also we're looking for areas where you see all of the competition are older facilities that are fully occupied. Because as I said earlier, if we can build a new facility in that marketplace where there's, high household income, strong aging demographic growth with older facilities, our chances of being successful for our investors is pretty good. So.
Okay. And Taylor, question for you. People asked this to me as well about depreciation on the DST. They're used to their own real estate. What do people experience with the DST in terms of depreciation and other benefits of owning real estate that they're used to when they do a direct real estate?
Yeah, I mean, it's I guess it's different for statewide, but the typically you're having investors, maybe they're all cash investors. By taking on additional leverage, obviously you get an increase in your basis, and then you're sheltering that at a 39-year or 27.5-year if it's apartments or senior housing or something. So definitely, have the ability to shelter a lot of that cash flow for a lot of investors. If they have zero basis, they have the ability to grow that basis if they're in a 50 or 60% loan to value, and the same depreciation goes through for these products as it does with any traditional real estate. I'm not a tax attorney or a CPA, but I'm giving you, we deal with this a lot, so I can give you that feedback, I guess.
So I've got a couple more questions, but I wanted to open up to the group to see if there's any questions people have for these two people, gentlemen.
Question from Taylor. What does the loan look like on your deals, other than the loan to value share? I mean, there's no recourse or anything like that. Is that what you're asking? Or sources, CMBS, and other companies? Yeah, CMBS. Not as many life companies. You have some local, lenders. Again, a lot of the senior housing deals have been done more with regional or local lenders. KeyBank does a lot for the CMBS side. Yeah, I mean, a lot of the big boys, but probably another reason why apartments are so relevant in the space is the DST jives well with Fannie and Freddie, so they'll do the financing, and so apartments, you get the best financing, and you get a very ready lender in that regard, but you don't get that for all the other asset types. Senior housing, they have done a couple of them, but they kind of got away from it. The two that they did, Freddie and Fannie both did some senior housing several years ago, and those deals didn't go very well. The bad operator, and so they kind of dipped their toe in and then got it right back out. So, but they're looking at it.
And some of the DST companies I work with have assumable loans, which makes it attractive when they go to sell it, a few years down the road, where you're at a better rate than what we project it to be. So it's an attractive component too for investors when they're comparing owning real estate directly, even triple net versus putting money into a DST.
Yeah, there was a HUD financing deal that was assumed. There's 30 years left on a 35-year HUD loan. That's the only one that's been done, and the loan to value was enough to have it make sense for the project.
I know very little about DSTs other than what little bit I've heard here and there, but I want to use an example, $1 million retirement investor that's going to buy into one of these. Typically, what's his buy-in fee? What's the typical hold period? And what does it cost if he exits early?
Yeah, I can answer those if you want me to. Don't go into these with the intention of exiting early. These are illiquid investments. You're one of 50 investors, so there is a secondary market for it, but it's very small. You're going to take a discount on it. So if you have the intention that maybe in 5 years you might want to sell, this is the wrong investment for you. Costs on these on a total value basis, for the sponsor to structure it all, put the financing in place, the financial advisor and everyone to get paid, you're probably going to be in the 7 to 10% on total value. Smaller deals that have higher fixed costs are probably going to be maybe a little bit higher because the legal fees and things are fixed regardless if it's a $100 million deal or a $10 million deal. 5 to 10 are very typical. There are some programs, I think someone was talking earlier about kind of an UPREIT program that's available. There are a few groups that are doing that now. Those are unique, so there's a lot of technicalities to that that's probably not appropriate for this, but happy to talk to you about it more. But the traditional DST deal is going to be a 5 to 10 year. People are more looking towards 7 to 10, and 10 is really what they're looking at. Again, for single tenant deals or apartments, they're kind of saying, hey, we don't want 5 years because we're thinking maybe the economy might adjust in 5 years, and the last thing we want is, a credit crunch or something where the markets are frozen and you're unable to get a loan at that time. DSTs are not structured to refinance or do anything like that. Again, the technicalities of it are no moving parts. So if you have to refinance or something, you have to do what's called spring into an LLC, make the adjustments, spring back to a DST, which can be challenging and consuming and could be tried from an IRS perspective on the ability to do a 1031 out of it. That's a lot of info. Sorry, hopefully I answered the question for you.
Is the HUD loan applicable to private pay?
Generally, we're doing loans with regional national banks, so yeah, that's not something I don't think they traditionally look at.
Yeah, and I'll speak to that as well because I work with James really closely. His projects, again, they're trying to exit by 2021. So their model is to go, they actually have a developer that gives them the financing to go vertical with it, and so that's in place. Then they'll get a regional group for maybe 1 to 2 years for the lease up period, and then they're selling it. They're no intention to try to hold it beyond that. If it's a bad time to sell, they could hold it longer. Past 2021, then it would become an income play until it's appropriate.
And most
to
of
sell.
the buyers, they don't want to assume the loan we have anyway. So we usually do 3 to 5 year variable rate loans. At the end of the day, usually it's a bigger buyer coming in that has, lower cost of capital they can access through their own lender. So,
Starting to see opportunity zones, which is a different, unique strategy that's starting to come out. If anyone here is familiar with it, it's a brand new concept where people are investing in specific areas, holding it for 10 years, and then they don't have to pay the capital gains on that. And so you might see some situations where HUD gets involved more, but those are really going to be for a longer term hold period, because you're not going to have a buyer that wants to come in if the HUD loan's down to 40%. Private equity buyers are more in 70, 80%. And, a lot of the public companies want that.
One final comment about your question about potential investor. Once the funds are received from the QY into the DST, interest is accrued that same day that they close, and then the distributions, monthly distributions, if there are distributions, are paid out the following month on a monthly basis.
Yeah, these groups that are, hey, I want to close the exact day I get into it, these are structured. They're ready to go. You can close on them immediately, which is really nice for the seller.
Matthew?
I just had two questions. One for you, sir. If I was to invest in your fund, am I investing in a development play or am I investing in a stabilized product?
yeah, it's all development. It's, again, we build, lease it up, and then sell it. No income at all. It's, 100% growth.
Gotcha. Another question for you. There's a lot of discussion about older folks going into these and their long-term hold. Talk about how easy it is to pass that on to their heirs.
Yeah, from a tax perspective, I mean, it's morbid, but swap till you drop, right, on a 1031 exchange. So people that are 85 years old are kind of planning on dying, essentially. This is something where, instead of paying the capital gains taxes, you're deferring it, you die, your inheritance get a step up in tax basis. That's where some of those programs where you have the UPREIT program could make sense from a, you get the money back. One brother wants to reinvest on a 1031, one of the two sisters want to sell it and get the money out. An UPREIT can be something where they can do what they want at that time.
Don?
On the senior housing fund, is that eligible for qualified dollars?
It is. There is a UBTI component to it, however, that, has a little bit of an impact on the total return. We pay out a 12% preferred return to the investors plus their principal back before our company as a sponsor gets paid a dime on the fund. So there's a priority payout.
Second question, or two follow-up questions. What's the minimum investment, and is it structured as a Reg G private placement?
Yes, yeah, it's a minimum investment of $25,000. You have to be an accredited investor to participate.
$1 million net
Thank you.
worth excluding your residence or $200,000 of income.
Go ahead.
Is there any concern with, the potential tax laws changing with
I mean, if they sign out the 1031, yeah, there's definitely that consequence. Unknown what's going to happen with some of the certain long-term gains, but the challenge is, or deferring the capital gains is really the primary reason for these. And if that goes away, obviously will significantly impact DSTs in the future. But without that, there hasn't been, as the capital gains went from 15 to 20% on a federal level, more people were inclined to do that. I heard today, Oregon's a 9% state, whereas Washington's 0. I'm in Salt Lake, I'm in Utah, it's 6.25. So different states have different responsibilities. California, we probably have 50% of the market shares coming out of California because they pay quite a bit in state taxes on top of their federal. So
It's called a weather tax, right?
yeah, coupled with depreciation recapture, deferring all of that's pretty meaningful for the 1031 investor. And everybody has to look at their own unique situation and how much they're going to actually pay and if it's worth doing a 1031.
So we'll stick around afterwards if you have other questions. A lot of nuances to this, but thank you for your time, everybody.